All right, let's move on now to our analysis. We have a question on gold, but we'll just start very quickly with oil, because this of course broke out all the way to around 127, showing here even $130. And if we're not already in the trade, we would want to see how we would want to get into the trade. We were looking at a climatic top for the market. Remember this, sorry, that we realized that we're in a wave 5, and on the weekly and monthly charts we were expecting the market to break out very suddenly in a parabolic climax. This occurred over the weekend because of that actually news release regarding an oil embargo on Russia. Okay, so this is definitely going to come into effect. At least the United States is going to actually place an oil embargo on Russia. The move is, we believe the move is designed to get in as many shale oil producers into the market. With oil now at $130 and $120, you have a very strong, robust oil industry in the United States and Canada. Could be actually, in light, of course, notwithstanding the inflation, it could actually be a booming driver for the US economy. And gradually we will see that shale oil is being substituted and supplied to Europe. Also, the technology is going to be exported to Europe, all right, to increase shale oil production there and stand out of supplies of oil, at least out of Russia. So we expect fundamentally for us traders that oil is going, shale oil at the current production levels, you need to really increase production, at least in a very significant number. We will have to do some resources on that if you want to see the price of oil move below to $95 and at least $95, these kind of levels. At the current production rates, you're looking at 120 and 125. So now this is now established. So we expect that oil will be moving higher across the current, at least into the current quarter. You're looking at levels between the current level 120 and 140 and 135. So that top out or blowout or climatic top out is not yet over. We still expect testing of 134 shown here, $135 and $139. There's very strong momentum, of course, across the board on all time frames, and therefore if you're not already, our strategy was always to take profits on a daily basis at the internal resistance 1 levels and buy at least upfront at 78.6% on a daily basis. If we were holding any contracts as of last Friday, that would be of course very fortunate for us. I'm not sure we are, because we would have actually close to taking profits, and the move was sudden. The move all the way to 126 was sudden, but we would consider to get into it now. You're looking here at the 4-hour chart, all right. We all remember our strategy is always to buy into the growth cycle on the 4-hour chart. The growth cycle on the 4-hour chart is shown here, right below us. The growth cycle before us, sorry. The growth cycle on the 4-hour chart is actually this cycle now that is being capped by the neckline shown in green. You're looking here at the green neckline at the top and a green line, just neckline at that level 2 here and showing yellow. You're seeing, of course, 123. This is the current growth cycle. This cycle should correct all the way to 50%, we believe, because there is a gap here and probably it will correct to 50%. We're looking at entry level of $117, $118. If you are not already long, you would want to enter at 118. Okay, so the level management half size, this we would consider is the market price, 118. If we get to see a deeper correction and that growth cycle gets taken out, it's not really, and we don't really expect this to happen because of the current fundamental driver regarding a ban on oil imports out of Russia, or oil exports out of Russia. So just in case we do get A larger degree correction would stand out of that growth wave here on the 4-hour chart between these two green necklines, and we buy 50% into the next cycle, all right, below the current growth cycle. The next cycle is shown, of course, by that lower green neckline at $90 and that green line at $107. 50% of this comes in at $100 flat. So we'd add half size there. We're buying 118, all right, half size, and we're adding at just $100. It's expected that we get a bounce at that neckline, at the cycle top, okay, or at either of these two moving averages, 50 and 200 point moving average. If we get that, you will get a bounce to at least probably 50% of that higher growth cycle, all right, if not doing another head. So the level management is shown here, or the trade management shown here in that matrix. We're looking then to buy at or below $118 half size. We're looking to add at $100 full size. You're looking to average around $109. The stop, of course, we can actually close out, or if we don't have a good strong momentum picture or we're not comfortable, we can close out at that right shoulder here shown in yellow on the left, sorry, on the right shown in yellow at $118. So for the full contract, you're looking at $9 full size. It is possible, probably very likely, that we get another leg up. It will take us to $135. Remember, we are in a wave 3 over wave 5, and when we go to the 1-hour chart, you're looking at that label here, 3 into 5. When you go to the 1-hour chart, you'll find that this is actually extending and spiking. We will take a very close look at the 1-hour chart very shortly, and therefore our next move higher is going to be $135 at that level here, 138%. 138.2%. Now $135, we'll just be carrying half size, but if you are going in at 118, at 135, looking at $17 per contract. If we are full size and if we manage to actually have an average of 109 and we close out at 116, this is that shoulder level here, we would also be carrying $17 per full contract. So it's either 135 gives us $17 for half size contract that we would be engaged in at 118, and if we are fully engaged by buying 118 and 100, we would consider to take profits at 116 for the same sum of $17 in yield. So we would consider to buy into this over the coming 36 hours.